This is Chuck Carver. I'm the Chuck in the Markets Up Chuck. And today's blog was talking about an article I read in the Yahoo Finance on about 3 sectors to profit from this summer. And the author, David McDougall, gave 3 picks in each of the 3 sectors that he picked. He picked healthcare, utilities, and media. And I'm going to take a look at the 9 companies he looked at. And I kind of started from the lowest growers and kind of moving up to higher growers. To just give you a perspective, he made some compelling statements about each company. One of the ones in the utility sector was Xcel Energy. And he talked about this company being very attractive and standing out from the pack because it's the top wind provider in the country. It has a dividend yield, he said, of 5.3% at today's price. This was last Friday. Dividend yield, as my research shows, is around 5%, but that's the same number. Now, once you really look at this company, look at this company from a 15-year perspective. Number one, as you can see, earnings growth was very flat, and then it fell, and then it was very flat again. The company's had virtually no earnings growth over the last 15 years. Shareholders have received a decent dividend. However, the dividend itself has been erratic, where they have cut it in the past. The rate of return has actually been a negative 1.5% versus 4.6% in the S&P. So it's a compelling story, but yet when you look at it from the context of the analyzer tool, it's not quite as compelling as Mr. McDougall made it sound. I'm going to move on and go a little faster now. The next example in utilities was New Jersey Resources. Here you have a 3%, 2.9% dividend yield. I want you to notice that, the stock price is correlated to the earnings growth very closely. The company has generated about a 9.6% return, not counting dividends. The dividend has been a lot more consistent. So, if you're looking for a nice, safe play with a decent dividend yield, I might like this recommendation. It really makes some sense. And then the next one, of course, was Florida Power and Light, or FPL Group. And again, you have about a 7% grower, a 3% dividend yield. I do want you to notice that, when you're looking at each of these companies, this correlation between the growth rate of the company and the return shareholders earn, not counting dividends, is always going to correlate very closely. This is probably a decent buy today. If you're looking for a nice, safe investment with a 3% dividend yield, then I think FPL might actually, make some sense. The Xcel Energy, though, to me was a dubious pick because if you really remember from looking at that picture, the stock really didn't ever really do any major running. Now, he went into the media side. He singled out first one he singled out was Disney. Now, Disney is a well-known name, obviously, icon of Americana. It's the Mickey Mouse franchise, etc. But when you look at it from the standpoint of its long-term growth, it's only grown at around 6%. It does pay a little dividend. Earnings are, very erratic at best. From a long-term point of view, the company has actually underperformed the market by a rather extraordinary amount. I would argue that perhaps today it's trading at a abnormally low or certainly a reasonable valuation with a little dividend yield. But again, you have to look at this company, look at its record, look at the perspective, and then you decide for yourself whether this is something you'd like to have in your portfolio. The next example we gave was DirecTV, and again, he gives good, write-ups on each of the companies. He talks about DirecTV having a return on equity of 27%. He says its shares are only up 3.5% this year, and that earnings are expected to increase. But if you look at this company from a 15-year period, there's really been no traction on this stock at all. About a 4% return, very erratic. So, once again, is this the kind of company you want to be a long-term owner in, or is he talking about a short-term trade? And by the way, he could be talking about either, and I'm not making a value judgment there. It's up for you to decide whether that's the kind of thing you want to own or not. Now, on the other hand, he also mentioned Netflix, which, has some pretty exciting and compelling metrics behind it. It's past 10 million subscribers during the first quarter. He talks about. He said the price has soared 35%, beating the market and arch rival Blockbuster, whose shares have fallen 46%. Analysts expecting earnings growth of 20% for the year. And I don't have a forecasting chart here, but I do want to point out that the company's trading at 27 times earnings. So even though it's had this tremendous growth, and the record of this company is extraordinary. Over an 8-year performance period here, it's all the company, old as the company's been. Shareholders have earned almost 28% a year versus -2 in the market over that period. I would argue the stock is a little pricey, but this might be an interesting, company to research further because it certainly does have the growth if you're looking for growth. If you're looking for more conservative investments, then, perhaps, a couple of the utilities we talked about, New Jersey Resources or FPL might actually be better choices. Then he talked about healthcare and certain aspects of healthcare. And one of my favorites is Teva, which is the world's largest generic drug manufacturer. You can see the company's had very consistent earnings growth. It's trading, currently at a discount to a more normalized price-earnings ratio or a more normalized growth rate for the company. So it's probably an attractive buy here, in my opinion. It has a great record. It's averaged over 20% a year for the last 15 years versus 4.6% in the market. So here's a choice you might want to look further into that might actually make a whole lot of sense for you. And then the last example that Mr. McDougall gave was Gilead Sciences. It's a biotech company. You can see it's it had no earnings for the first half of this 15-year period. But earnings, once it started to get its kind of mojo, the earnings have been extraordinary. I do want to discount this 290% increase though, and I thought it might be wise to take a look at this company a little more currently. So if you look at Gilead just over the last 6 years, taking out that 290% earnings growth when they first started earning money, you can still see the company's been a very consistent grower. Even through the recession, they grew earnings at 14%, trades at 19 multiple. This might be an attractive long-term play. It has a great track record for its shareholders. So here you have it. A recommendation where he recommends 3 sectors, and what I really wanted you to see, the reason I thought this was interesting and I wanted to share it today, I just find the perspective so different, yet all 3 were offered up as 3 excellent areas to invest in, and yet when you really look at them from a fundamental point of view, and even from a historical point of view, there's a significant difference in the track records, the returns, the earnings power, the fundamental values of each of these companies. And that's why I think it's so important not to think in general terms, even as it relates to sectors, but always think specifically. Hope this gave you some additional insights in investing. It's Chuck Arnville saying thanks for listening, and I'll talk to you again tomorrow.